Welcome to the USA Financial Trending Report podcast, a candid and educational discussion regarding the state of the markets, economy, and other factors that may impact your investment accounts. The host of this podcast is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. This podcast is educational and not intended as personal financial advice. Seek the help of a qualified financial professional regarding any strategies discussed. Investing carries an inherent element of risk and includes the potential for loss of principal and income. Past performance is no guarantee of future results, and your actual results may vary.
The stock market has been showing some signs of strength, but GDP and unemployment data are at odds with each other. We're going to talk about what this means for the market and the economy and how all of this is scoring out on a macro and a micro level. Welcome once again to the Trending Report. Today we're going to be discussing data ending August 5th, which is last Friday. Again, we look at data both on a daily and a weekly period as we're calculating our trending numbers and our scoring numbers. So in a few moments, I'm going to walk you through the ranking, so to speak, of the scoring of the market based on capitalization, going from large cap all the way down to small cap. And then we're going to take another look at it from a sector viewpoint, looking through the lens of the 11 different sectors that make up the stock market, and again, compare macro to micro. So now once more, micro means we're taking daily periods into our calculations, whereas macro means we're taking weekly periods into our calculations. So what happens is the micro oftentimes gives us a viewpoint of where things are going, kind of ahead of the curve, if you will, and then the macro will often follow. But sometimes the micro gives us a little bit of a false reading, or it just bounces around a little bit more, and the macro tends to be more stable. So it's very helpful to look at the two of them side by side, which is exactly what I'm going to share with you today. And then we're also going to compare GDP next to unemployment, because there's some really interesting data coming out there, and we're seeing some historic changes in how those two numbers are being reflected, at least in how they interact with each other. So we'll be touching on that for you here today as well. So with that being said, let's first start off with a viewpoint of the capitalization rankings. So once again, as I mentioned, we're going to compare macro and micro, just as we show these right here. And in doing so, we're going to first notice that the overall stock market is jumping up on a micro basis. So the total U.S. stock market in the shortest term calc, in the micro calc, is moving up. So it's gaining strength, it's gaining momentum. It's been performing in the short term, and it's increasing its status with a micro lead up compared to the macro. What also really jumps out is the aggregate bonds. So the overall aggregate bond market has dropped immensely, going from the number 6 spot on macro down to the number 14 spot on micro. So as the stock market is increasing in its horsepower, so to speak, the bond market is turning back and dropping down in terms of how it relates to the scoring mechanism. Now, cash, which is reflected by the 3-month T-bill, that's right down here, pretty much at the bottom. Not a whole lot of difference there. But what is unique and what is interesting is we're seeing that the 3 leaders in the clubhouse, so to speak, on the micro level, which is QQQ, that's the NASDAQ 100, the S&P 500 growth subset, and the S&P 600 small cap subset, are the exact same 3 that we're seeing in the macro. Now, the order has changed a little bit, but the top 3 is the same in both instances. Now, keep in mind, we're also subsetting based upon growth, value, and then the overall index. Normally, what will happen is you'll either see growth, then the overall index, then value, or you'll see value, then the overall index, then growth. And the reason being is because when you subset it down to compare growth versus value, the S&P 500 or the S&P 600 or the S&P 400, those are all overall indexes. That's the average of them all. So either value is winning and pulling up against growth or vice versa. So right now what we're seeing is we're seeing growth is winning the day in both the S&P 500 and the S&P 600, and we're seeing that on both macro and micro. And then, as I mentioned, we've got the NASDAQ 100 in here, which tends to be kind of a growth-oriented, kind of a tech-oriented collection of 100 stocks, the largest 100 stocks on the NASDAQ market. So very interesting how we're leading the charge with the same three. We're seeing the overall market take an uptick. We're seeing the overall bond market take a downtick. Now, let's take a look at it from a different viewpoint. Similar data, but now we're going to look at it through the viewpoint of sectors. So here in the sector arena, we stage it out very similarly, and you'll see the overall stock market is edging up a bit, but not as dramatically as we saw in capitalization, because again, the overall market is still subsetted by these 11 different sectors, and therefore the overall market oftentimes or generally will be kind of an average. Just like we talked about a moment ago, with half of the, or a collection of sectors above it and a collection of sectors below it, which is exactly what we're seeing. But the overall market is increasing for us a bit. And again, the bonds are still dropping because that's really the same overall data from the market, whether it's sector or capitalization. And we're seeing a sort of a unique phenomenon where we got the same three happening again here, both the same on macro and micro, just like we saw a moment ago on capitalization. Now we're seeing that kind of duplicated, but with different slots being filled on the sector side. So we've got the Vanguard, we've got industrials. We're using the Vanguard ETFs to illustrate this, but we've got industrials, we've got information tech, and we've got consumer discretionary. And then we've got industrials, we've got information tech, and we've got consumers discretionary. So a little different order, but same end result. And now again, we do see cash down at the very bottom. That was a bit of a jump. Some of these sectors have been doing very poorly, and therefore cash on the micro got pushed down as these sectors started to jump up a bit. Now, keep in mind, though, we are still seeing, here's the line for going to zero. So almost all of the sectors in the micro are in the green, except for, except for cash. So all the sectors are in the green in the micro, but in the macro, they are not. So again, the market is getting some steam behind it. We don't know if this is temporary, prior to a deeper recession or moving us into recession, I should say, or if this is the turnaround, this is the bottom. No one really knows that. And by the way, no economist knows that. No stock market professional knows that. If they tell you those sorts of things, they're being very untruthful with you. What's really interesting that also illustrates this point further is if we take a look at GDP and unemployment. So right here, I've got the GDP growth chart for you, and I've got the unemployment chart for you here. Now, the unemployment chart is illustrating monthly. GDP is illustrating quarterly, but these are the same time frames. Both of these are coming in over a 3-year time frame. What's interesting is that generally speaking, GDP and unemployment have a teeter-totter effect. As one's going up, the other's going down. So they have this teeter-totter effect that takes place. Because if GDP is going up, then unemployment generally is going down because those are both good things and they tend to go hand in hand. On the other reverse side of that, if GDP is going down, then generally speaking, unemployment is going up. People are losing their jobs because the economy is not doing well. And so again, they tend to be related, but they have a teeter-totter or a contrasting reflection in their numbers. So normally that's what we see. And we saw that leading up to the pandemic. They were both basically flat, which makes sense. Then the pandemic hits and we see this spike down in GDP and we see a spike up in unemployment. Again, exactly what one would anticipate. And then as GDP hit the bottom and starts to rebound and increase dramatically, we see a dramatic drop in unemployment. So as this spikes up, unemployment spikes down, so to speak. But what's really interesting is what's happening the last few quarters. GDP continues to go down, but unemployment is still going down. So now all of a sudden, both ends of the teeter-totter are actually going down. This is not generally seen. In fact, I don't know if it's ever been seen before. And we're back down to unemployment of 3.5%. We saw 3.5% under President Trump. Now we're seeing 3.5% under President Biden. That is a historic low. Generally speaking, historically speaking, economists will often say that 4% unemployment is essentially full employment, meaning that 4% of the people simply do not want to work. They're not looking for jobs. They're not trying to get gainfully employed. Therefore, 4% unemployment is, quote, full employment. So we've gotten either, if you believe that quote, that means that we've got some people who normally don't even want to go to work. We've got them working. So historically low unemployment at 3.5%, which normally means GDP would be going up, but it is not. So one could say that these two things are kind of opposing forces. Is unemployment being so low showing us that the market is about and the economy is about to take a turnaround and go back up in the direction we want it to from a growth perspective? Or is GDP a more realistic view because of supply chain issues and all the other things that are going on, that GDP is continuing to drag down and the low unemployment is a false indicator or maybe a blip that's going to turn back the other direction? We don't know which one is going to win, but eventually they're going to have to kind of give one way or the other. Either GDP is going to prove to be true, that it's continuing to go down, the market and the economy will continue to go down, and then unemployment will likely come back higher again. Or the unemployment indicator is telling us that no, unemployment, the businesses know something that GDP isn't reflecting yet. Unemployment is low, and therefore GDP is about to make the turn and start going up as well. No one really knows, but it's a really interesting thing that we're going to be watching closely for you. And we will come back with you in a couple of weeks with even more information. Thanks, everyone. I hope this has been helpful to get your arms around what's going on in the market, what's going on in the economy, and how to read some of these charts. Thank you.
Thanks again for listening to this episode of the USA Financial Trending Report. To gain instant access to this monthly Trend Tracker publication or to find out more about USA Financial Formulas, simply visit usafinancialformulas.com. Any USA Financial Formula strategy may underperform or produce negative results. The strategies and screening tools discussed in this presentation are only tools designed to move assets into or out of the market based on various economic and market indicators. These tools do not guarantee specific results, and even with the application of these tools, it is possible that your account will lose value. Research partners mentioned are independent companies and not affiliated with USA Financial Formulas. You should only invest in the USA Financial Formulas upon receiving and reading the Formulas ADV.